Welcome to the Ellsworth Advisors monthly update for September 2025. I'm Kelly Keenan. This is Cameron Mealy. Today we'll discuss the latest economic news, how our portfolios have performed year to date and through the month of September, and also what our outlook is going forward. Cameron, why don't you kick us off with some economic research?
Perfect. Will do. Thank you, Kelly. And I hope everybody is well out there. Today, for reference, is Wednesday, October 8th. Biggest economic news is we are now in day number 8 of the government shutdown. Don't think really anybody out there watching this video, it doesn't really affect us in Main Street America yet. The market really is looking past it. We're talking about non-essential personnel that are currently not working. This has caused delays in terms of economic numbers. So jobs report, those sorts of things we're not going to see. Really, this shouldn't have much of an effect as long as both sides come to the table soon, get the government back up and opening. Really, the problem we have with a delayed shutdown is that federal employees who do get furloughed may go off and find other jobs. Then you have restaffing issues, you have information void issues. But as of right now, the market's taking this in stride. I do believe, hopefully, cooler heads will prevail, and we'll get the United States government open soon. I guess the one good thing is if the U.S. government closed, they can't waste taxpayer dollars. So that is kind of a net benefit, but don't expect this to be a huge issue. Other piece of significant economic news is Fed funds rate. Following their September meeting on September 17th, the Fed announced a 25 basis point reduction in the Fed funds rate. New target Fed funds rate is now 4 to 4.25. There are 2 meetings left in 2025. The Fed will meet October 28th and 29th and December 9th and 10th. I expect still a 25-point reduction in the Fed funds rate. I do believe that'll come in December. But we will talk about the numbers we're seeing again, strength and weaknesses, and maybe the government shutdown in combination with some of the weakness in the jobs market maybe does push them for an early cut. But I think we do see one more 25 basis point cut this year.
Yeah, I think we'll be below 4% by the end of the year, 1 or 2 cuts. The reality on the Fed funds rate is a lot of argument. It should be more low to mid threes at best, just based on kind of the inflation level where we're sitting at these days, around 3%. But that's yet to be seen. And what the Fed's always focusing in on is inflation and unemployment, or employment, however you want to say that. Obviously, with the government shutdown, the numbers have been in question for the last several quarters, several months.
This isn't going to help things.
This isn't going to help things. One reality in the employment picture is really over the last 3 years, employment gains have kind of been driven by the government. Private sector jobs have pretty much been flat. So yeah, there's going to be an impact if furloughs turn into terminations, which has been threatened. Obviously, that could affect the jobs numbers. The other thing affecting jobs numbers is lack of immigration. New jobs aren't being created if there's not new workers coming in. So that's influencing the numbers. And also starting to see signs or basically a narrative around, once again, kind of a mismatch in jobs and skills workers have, available workers. So that's causing some friction in the job market, which that element has been with us in the past. I think it's always with us to some extent, but maybe a little bit more heightened at this point in time.
Absolutely. At least heightened in the news.
Correct. Exactly.
So let's talk quickly about the numbers. We're still working off of a stellar GDP. On September 25th, the Bureau of Economic Analysis reported that according to its third estimate, GDP in the second quarter increased at the annualized rate of 3.8%. That's an increase from 3% that was reported in the advanced estimate to 3.3% for the second estimate, now to 3.8%. This compares to a 0.5% decline in the first quarter. Again, first quarter, a lot of shock from tariff announcements. We saw that play through the economy. Very strong GDP in the second quarter. But again, what we've talked about was that really people that brought in inventory in the first quarter, thinking about inflation, and inventory when it comes in, purchases coming in is a traction from GDP. When that inventory goes out, it's a net benefit. So I think really you probably have to take those two numbers and average them to get a proper look.
Correct.
But with that being said, according to the Atlanta Fed's GDP Now forecast model, as of October 7th, the Atlanta Fed is expecting third quarter GDP to increase at an annualized rate of 3.8%. So GDP, the economy, at least from a purely statistical standpoint, does seem to be on a strong footing.
It's not bad. I mean, it's stronger than I think expected.
Mhm.
So, I mean, we're looking at a decent growth year, at least up to this point. It's hard to see anything derailing it fourth quarter.
Yep. So let's talk quickly about, Kelly mentioned inflation. That is really the Fed's focus. The Personal Consumption Expenditure Index on September 26th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.3% in the month of September. For the 12 months ending September, the index is up 2.7%. Over the past year, we've seen the increase has been as high as 2.8% in January of 2025 and as low as 2.2% in April. The Producer Price Index. On September 10th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.1% in August. That's after an increase of 0.9% in July. And on a year-over-year basis, the index is up 2.6%. And my apologies, these all are August numbers because they were reported in September. The Consumer Price Index. On September 11th, the Bureau of Labor Statistics also reported that the Consumer Price Index increased 0.4% in August. On a year-over-year basis, the index is up 2.9%. So we still have inflation running above 2%, but below 3%. GDP is strong. Biggest issue we just talked about is the employment. Obviously, the team at the Bureau of Labor Statistics is currently on furlough. So on October 3rd, they would have reported the September jobs numbers. That didn't happen. But we do have ADP. As most of you know, ADP is one of the largest private company focused payroll companies in the industry. ADP does do a monthly survey of private payrolls, and they came out on October 1st and reported that U.S. private sector lost 32,000 jobs in September. So obviously we don't have confirmation from the Bureau of Labor Statistics, but ADP is pretty darn good at this. At least the trend is in the right direction. So we're looking at, job losses now in September, a lot of it because of uncertainty around shutdown, continued uncertainty around tariffs, a little bit of concern on the overall economy, and obviously the immigration issue.
Yeah, so there's a weakening, but not a collapse.
Yep.
That's, typically you see that the kind of weakening we see typically happens when you are in recession because employment tends to be a lagging indicator. So employment's kind of a big question mark out there. We know it's not strong. We know it's not falling off a cliff. It's just, continues to soften. On the inflation side, once again, we're kind of hanging around that high twos, low threes number. A lot of strategists do think we could see a little tick up in inflation, more in that 3 range. So it's been fairly stable. Not a whole lot going, not a lot of progress being made, but once again, not deteriorating. But that risk is out there.
And with the jobs, it's really hard. The Bureau of Labor Statistics is literally surveying thousands of employers who are reporting on millions of people. It is a backwards looking indication of the economy, but it's not a perfect one.
Correct.
It's nice to give you directional, but it's really hard to get all of this wrapped up into an accurate number a couple of days after the month closes. So you always have to take the employment numbers with a little bit of grain of salt. We've seen major revisions in 2025 and the second half of 2024, but it certainly appears that the employment situation is the weakest segment of the overall economy.
Right. And, there are signs of the economy actually heating up a little bit, just based on the GDP numbers. So we're kind of in this period where the market tends to do pretty well, as shown by the August or September numbers. Typically, September tends to be, historically, is one of the worst performing months of the year. This year, that was not the case. In September, the S&P 500 was up 3.53%. The Dow Jones 1.87%. NASDAQ was up 5.61%. Russell 2000, which measures small cap stocks, up 2.91%. International cooled off a little bit, only up 0.95%. Emerging markets did well, up 6.46%, and the Bloomberg U.S. Aggregate Bond Index was up 1.13%. That on a yearly basis, that takes the S&P up to 13.72%, the Dow Jones up to 9.06, the Nasdaq up to 17.34, the Russell 2000 9.2, international, the EAFE up 21.51%, emerging markets having a great year up 24.57%, and the bond index is actually up 6.18%. So across the board, um, people are making money with their investments. What we don't follow is, and we'll see in a second, is commodities have also done pretty well this year, especially gold.
Gold has been on an
Gold has
absolute
been
charge.
on a roll, that's for sure. Um, our portfolios for the month, dividend yield. Well, one thing you'll notice in those numbers is we've kind of gotten back to where the market is definitely being driven by growth stocks, tech stocks, AI stocks. Your more defensive stocks, dividend producing stocks have kind of been the unloved child, where they're not getting a lot of love. They continue to make money, but performance has not been there, as evidenced in our dividend yield portfolio for the month, down 0.73%. Year to date, it's only up 3%. We saw some signs of life in August, and not much happened in September. Big gainers in September. Old Republic was up 6.25%. J&J, Johnson & Johnson made a nice little move, up 5%. Medtronic up 2.6%. From a lagger standpoint in September, Darden Restaurants was down 8%. Bristol Myers down 4.4%. PNC Bank was down 3%. Year to date, our big gainers in that portfolio: Altria up 26%, Johnson & Johnson up 28%, American Electric Power up 22%, Medtronic up 19%, but our laggards, Bristol Myers down 20%, Packaging Corp down 3.2%, and Public Storage down 3.5%. So that's kind of our big laggard for the month. Our appreciation with income portfolio, September was up 3%. Year to date, we're up 16%. Big gainers, Lam Research up 33.7%, Amphenol up 14%, Broadcom up 11%, Eaton, which we bought beginning of the month, up 7.2%. Laggards, Freeport McMoran down 12%, EOG down 10%, Moody's down 6.5%, Synovus down 5%. Year to date, Lam Research, our big gainer, up 85%, Amphenol up 78%, Broadcom up 42%, Meta up 25%, Microsoft up 23%. Year to date, EOG, their natural gas producer, down 8.5%, Zoetis down 10.2%. Growth with income portfolio, for the month up 2%, year to date up 14%. More of a balanced portfolio, big gainer in there. Gold's up 12% in September. Apple is up 9.7% in September, finally showing some life in Apple. Nvidia up 7% for the month, and Raytheon was up 5.5% for the month. Big laggers, once again, we have AOG in here also, down 10%. Nike down 9%, and Nucor down 9%. Nike did have a nice rebound at the beginning of the month of this month, kind of help ease the pain there. Year to date, big gainers. Gold's up 47% for the year. Raytheon up 45%, Nvidia up 39%, J&J up 28%. Our commodity fund that we use in there, that's also up 16.6% for the year. Once again, year-to-date laggards, EOG down 8.5%, Pepsi down 7.6%, Honeywell down 7%. Our price potential portfolio struggled last year. This year having a great year. September up 7%, year-to-date up 26%. I think we crossed over the 30% number yesterday. September gainers, Celestica up another 26.5%. Anglo Gold Ashanti up 24%. Vertiv up 18.3%. Google up 14%. We have laggards for the month. Mercado Libre down 5.5%. T-Mobile down 5%. Amazon down 4% for the month. Year to date, Celestica, our big winner, up 167%. We bought that, I think, in April. AMD, Advanced Micro Devices, up 34%. That doesn't include the big move yesterday. Google up 28%. Goldman Sachs up 39%. And Mercado Libre up 37% for the year.
Way to go, Mercado Libre.
Really, at this point, we don't really have any laggards left in the portfolio. We've basically blown out all of those. Uh, and for I'm sorry, here we go. Our SMID portfolio, our small cap portfolio, decent month last month, up 3.6%. We finally got back into the black here for the year, up 1%. Our big gainer in September, IBEX up 37%. Astronics up 25%. Idaho Resources up 20%. TAT Industries up 22%. Laggards, Northeast Bank down 9.4. Bank First down 6.6. Descartes up, down 5.7. Some of the banks felt some pain, but we're starting to see a lot of action in the banking arena.
Oh, what you said, a big bank merger announced?
Yeah, so these smaller banks, there's stuff happening in that market. So I wouldn't be surprised if we get some takeouts, especially with stock prices being a little bit depressed. But the expectation is financials should do pretty well, you know, in a more normalized yield curve environment. That's good for banks, and just the environment's right for banks to do well. Year to date, IBX is our big gainer, up 88%. Bowman Consulting up 69%. Ligand up 65%. WNS up 61%. No big losers year to date. Once again, we kind of weeded out that portfolio. So that's kind of where we stand. October historically is the most volatile month, but it's not the worst month. So that means choppy, but to the upside. So that's positive. I think we have a lot of momentum going into the end of the year. You're starting to see some performance chasing by investment managers.
Yeah.
That should help, push the market higher. Earnings are expected to be halfway decent for third quarter. So I think as a whole, we're probably looking, for more gains, definitely into the end of the year. October, we should be in pretty good shape.
Yeah. I mean, we'll see if we get that classic Santa Claus rally going into the end of the fourth quarter, but it's been a good run. Our portfolios have done great. I'm really happy with how everything's positioned. We got to keep an eye on the numbers, keep an eye on hopefully our bloated and inefficient government getting back to bloated and inefficient work. But it's been good. So as always, thank you on behalf of Ellsworth Advisors for your trust. If you have any questions about your accounts, please do not hesitate to reach out to us, and we'll talk to you in another month. Have a great day.
Thank you.